Welcome everyone to BC Mortgage Insider. I'm Anthony, licensed mortgage broker in British Columbia. Before we start, please like, comment, and subscribe. It will help the channel grow. And now to the video. Big news coming for real estate investors. OSFI, Canada banking regulator, is starting the rules again. Starting in 2026, new change to the capital adequacy requirements, or the CAR guidelines, will completely change how banks treat income-producing properties, and by extension, how you investors qualifies for mortgages. Let's break it down simply. What's changing? What does it matter? And who's going to feel it the most? What exactly is changing? These changes target how banks measure risk, not the borrower rules like the B20 stress test, but how lenders must classify and hold capital for mortgage tied down to rental or investment properties. In short, if the property payment depends mainly on rental income, it is now officially labeled as an income-producing residential real estate. That triggers a whole new set of rules. No more double-dipping income. This one's huge. If you're using income, whether it is your salary or rent from the one properties to qualify for a mortgage, you can't reuse that income to qualify for another property. Each new properties has to stand on its own, with its own income, its own debt coverage, and its own justification. This is going to slow down portfolio growth and cap how smaller investors can scale using traditional leverage. Higher capital requirement equals higher rates. Because income producing properties now viewed as higher risk, bank must hold more capital against those loans. More capital for the bank means more cost, and that cost will be passed down to borrowers. So expect higher interest rate, tighter loan to value rate limits, and possibly shorter amortization on rentals or investment mortgages. Bottom line is, rental property financing will be more expensive and more select. Combined loan product rules. If you have multiple credit products secured by the same property, say a mortgage and an HELOC, a default on one is now counted as a default on all tied to that property. Bank have now until 2027 to fully implement this, but that's another move that tightens the screws on multiple loan leverage. So why is OSFI doing this? To reduce risk and to make bank more resilient if the market takes a hit. But in plain English, they're trying to cool down an over-leveraged investor and stabilize housing system before it overheats again. How this affects investors? Let's call it for what it is. This is a major shift. Scaling will get harder. Rate will go up slightly. Lender will dig deeper for documents, proof of income, vacancy rate, expenses, and property-specific risk. So the broader impact on the market. Investor demand drops, especially in the small multiplex and condo market. Price could cool in investment-heavy sectors. Developer might face slower pre-sales, pushing more projects towards rental conversions. Private lenders and credit unions will fill some of the gaps, but with higher costs. Institutional investors, your REITs, your pension fund, could start buying more. That would consolidate ownerships towards the large investors. This could mark a shift where mom-and-pop landlords get squeezed out and the institutional landlords takes over. OSFI new rules do in practice tip the scale towards large income-producing investment, your 5 doors or more multifamily mixed-use assets, over the small-scale residential investment, your duplex, triplex, fourplex. So here's the truth. OSFI 2026 rules, these changed by OSFIs, are just another policy tweaks. They're a full reset of how real estate investment works in Canada. The small investors, the person who builds wealth on one duplex at a time, they're about to hit the wall. Tougher qualification, higher cost, less leverage. That old model of recycling income and scaling fast is done. Meanwhile, the big players, REITs, corporation, and funds, they're barely flinch. They got the capital, they got the structures, and they have the time to play the new game. This isn't just about mortgages. It's about control of the market. And right now it's shifting away from individual investors towards institutions. If you learned something new today, if you want me to dig deeper, please like, comment, and subscribe. See you in the next one.